Welcome back. Hemant Rustagi joins us to take your mutual fund questions. Thanks, Hemant, for coming by. There's Shiva Subramaniam waiting by from Chennai to ask a question. Shiva, hi, good morning.
Good morning. I have a query on the mutual funds investment.
Right.
I've got 10,000 to be invested on a monthly basis.
Okay.
Yeah. Should I have to go for mutual funds or the gold ETF? So I've got a 5 years horizon. I'm not looking at immediate returns, but I'm a bit confused. Which mutual fund should I have to choose and which gold ETF I have to choose?
Have you got any equity in your portfolio?
I've not got any equity in my portfolio. I've just started to learn investing. So first I wanted to start with mutual funds and then get on to equity.
Right. Well, just to clarify, Shiva, mutual funds also offer equity, debt, as well as gold. In your case, it's an asset class allocation that you need to look at, and all of that you can get within a mutual fund scheme, right? But I think it's not an either or for you. That should I put all my money into gold or should I put all my money into equity? That's not the answer to what you're asking for. It'll have to be a mix, right?
Yeah, okay. I already have HDFC mid-cap opportunities and diversified equity, which I'm investing 4,000 on a monthly basis.
Right, but when I asked you, do you have equity, you said no.
No, I thought about the share stocks.
All right, so that's equity as well. So 10,000 more you've got to put in a month, right?
Exactly, yeah.
All right, Shiva, listen in. We'll get Hemant to tell you what to do. Hemant?
Well, Shiva, you have a time horizon of 5 years, and as you said, you're already investing in, two funds. One is a mid-cap fund, and other one is a diversified fund. And you also are looking at basically whether you should be investing in gold. And as Vivek said, mutual funds today offer you, different variety of funds, and you can cover entire gamut of basically asset classes, be it debt, equity, or commodities like gold. What you need to look at is, when you talk about asset allocation, look at how much money you already are investing in debt. Maybe you have a provident fund reduction, look at how much it is, and when you talk about a 5-year horizon, and if the intent is to get healthy return, you can look at, equity-oriented balanced fund, and also a diversified fund, which you already have in HDFC equity, which is, investing around 55 to 60% in large cap and the rest in mid cap. So my advice to you would be you can have, one balanced fund, which could be HDFC Prudence, but the thing is you already have both the funds from HDFC. Generally, you should avoid that, then all your investment are in one fund. But since in this case you already have two funds, you can look at either HDFC Prudence or HDFC Balance. Maybe invest around 3,000 to 4,000 rupees in that, and the rest of the money you can allocate to the two funds which you already have in the portfolio. As for gold is concerned, you have these gold funds, you have ETFs, you have a gold saving fund, which is a very nice and simple way of, someone who was trying to accumulate gold over a period of time. My view is that at this stage, if your objective is not to accumulate gold, you can begin with equities, and as you increase your amount over a period of time, start including gold in that. Generally around 10 to 15% of your portfolio can go into that.
Well, next up, we've got an email from Akshay Jain, who writes in from Bangalore. And he's looking to invest in Reliance Pharma and Magnum FMCG, about 2,000 rupees for an SIP. What are you making of this, Hemant? Are both those funds good enough? Should Akshay consider making those investments?
Well, Samira, both these are actually, as the name suggests, are sector funds. The sector funds have a narrow, investment universe, which means that they actually invest in one particular sector. So if you really compare it with a diversified fund, which typically would have exposure to 8, 10 or even more sectors, sector fund tends to be more volatile and can be more risky. So I would say that someone who already has a portfolio and someone who has the potential to take or your capacity to take higher risk should be looking at sector funds. Should not be the bread and butter of the portfolio, which means that don't start investing with sector funds. Add them later on, but don't have exposure more than 10% in sector funds. As far as these two sectors are concerned, these are both considered as defensive sectors. They've done well in the last 1 year or so. In fact, I would say FMCG has done better than even pharma. So, but then that's history. What Akshay needs to look at is, like I said, if this is going to be his first investment, he should focus on diversified fund. If he has some investment, is looking to add some sector fund, maybe he can look at Magnum FMCG. And I would recommend actually a banking fund at this point of time, because the likely scenario is going to emerge is where you'll see the interest rate falling. So I think maybe he can look at Reliance Banking. But like I said, they should not be the major holding in the portfolio.
All right. V. Ravinder is now on the line. Hi, Ravinder.
Hi, sir. Good morning.
Good morning to you. What's your question today?
Sir, I invested in a Fidelity Mutual Fund, Fidelity Guaranteed Tax Saving Growth Fund.
Right.
In the year 1997, by investing 30,000.
Okay.
And DSP Merrill Lynch is in the beginning when it is 20,000 I invested. Whether I have to exit from that fund, I have to continue. I am a taxpayer. I want to save money through this mutual fund, tax saving.
Okay. All right. Hemant?
Well, Ravinder, I would like to ask you that you said about DSP mutual fund. Which fund do you have in DSP? Which particular scheme?
DSP Merrill Lynch.
Which scheme? That is a mutual fund name.
Rock Block Tax Saver is there.
Okay, so both are basically tax saving. These are ELSS. Basically, they have a lock-in period of 3 years. After 3 years, you can move money from to some other fund if you like. So if since you already completed 3-year period, and we have this issue on DTC, and if DTC comes into being from 1st of April, and the way it is being envisaged, then ELSS may not exist after that. But for the current year, if you are looking to save taxes, you can look at ELSS. Fidelity tax saving is a good option. You can add more to that. But wherever you have completed 3 years, because of this uncertainty which is there, my recommendation is that you switch the money to a diversified fund in case you have completed your lock-in period. So Fidelity tax, you can switch into Fidelity Equity, and DSP tax to DSP Equity or DSP Top 100, one of these funds.
Well, next up, we've got an email from Shakil Ibrahim, who writes in from Bangalore. He's quite young. He's 23 years of age. He's looking to invest about 25,000 per month across a few funds. I'm guessing he's a beginner, Hemant. So what do you advise him to do? What are the sort of funds he should be allocating the 25,000 per month towards?
Well, I think the important thing here is time horizon of 6 months. You want to invest through SIP over this period.
Yes.
Now, even though he'll be investing for 6 years, actually average holding period is going to be around 3 years. So since he's a beginner and he wants to invest around 25,000, I would recommend maybe around 4 funds to begin with. And his focus should be primarily on equity-oriented balanced fund, and as well as those diversified fund which are truly diversified and have bias towards the large cap. So maybe he can look at HDFC Prudence. He can invest around 6,000 rupees in that. He can look at HDFC Equity, which is a multi-cap fund. He can invest 6,000 in that. ICICI Focus Blue Chip, as the name suggests, this invests only in the blue chip companies. He can invest 6,000 there, and he can look at Canada Robeco Equity Diversified Fund. He can add 6,000 to that. So in all 4 funds he should, and in case in future he wants to add more money, he should be allocating additional money into these 4 rather than adding more funds in future.
Okay, Anil Bhatia has sent us this email from Delhi. He wants to invest money in mutual funds. He can hold on for 5 years, wants good returns, can invest 2 lakh rupees per annum. We all want good returns, but 5 years, is that a reasonable time frame for him?
I think the issue is that, anyone who's looking to invest in equity should invest, with a longer term horizon. The fact is 5 years is a decent time horizon, but depends on how you're investing. So if the money is being invested as lump sum, maybe it's all right. But if you're investing through a combination of lump sum and SIP, which is what one should ideally be doing, then I think it's always better to extend the time horizon, because that is when you get benefit from averaging as well as power of compounding. In this case, if he's looking at investing a lump sum, my recommendation would be that he should invest 50% as a lump sum and 50% through a systematic transfer plan. He can look at a couple of funds. Again, he must look at one balanced fund, which is HDFC Prudence, and then he can look at either ICICI Focus Blue Chip and Canada Robeco Diversified Fund. So 2 or 3 funds for a 5-year time horizon, with a combination of lump sum as well as STP, I think will be ideal for him.
All right, Hemant, thanks very much, like always, for coming by and taking our viewers' questions. That's all the time we have for in this edition of Talk Money. 236 points up, not moved much, the market, in the last half hour or so, but lots more action coming up right here on Bloomberg UTV.